Welcome to Electrified. It's your host, Dylan Loomis. So today, I'd actually like to take a look at some projections ARK Invest made on Tesla earlier this year. And shout out to Urban Arcologist on Reddit for sharing this post about the capital efficiency ARK projected for Tesla, as we'll now go back and use some new numbers to see how Tesla is doing. With so much attention on the stock price and S&P inclusion as of late, and now the pullback of the last few days, it's time for the Tesla community to shift back to fundamentals, things that actually matter. This will be as important as ever as we head into Q4 delivery numbers and the ensuing financials a few weeks into the new year. This report from ARK had a 5-year outlook, so we're talking about the trajectory and expectations of Tesla through 2024. So capital efficiency is just Tesla's cost per unit to build new production capacity, and it's this efficiency that sparks and accelerates the Tesla flywheel. If expanding capacity is too expensive, then the cumulative doubling of production, if you remember Wright's law, becomes uneconomic. But if Tesla can be capital efficient, spoiler alert, they are, then they can expand production quickly and affordably, lowering costs, increasing margins and returns on invested capital, and generating more cash for future factories. So if you're new here, they are doing all of these things as we've seen backed by Tesla's financial data from this year. To set the stage, the ICE industry average for capital efficiency is about $14,000 in fixed assets for every car produced per year. As we know with EVs, they are made with less parts, especially in the case of Tesla, and this moving parts number actually continually comes down. Ford and a few other companies have said that EVs could be produced at 50% of the capital investment necessary for gas-powered vehicles, which would be roughly $7,000 per unit volume of capacity. Basically, an EV factory could be built for $7,000 times the number of vehicles produced annually. So if the factory output was 150,000 cars per year, the factory would need to cost about $1.05 billion to hit the $7,000 capital efficiency metric. Taking a look at this chart, we see that on the high end, ARK was forecasting $11,000 per unit of capacity, which would be about $4,000 higher than expectations for the EV industry. While on the low end for the capital efficiency, they have about $16,000 spent per unit of capacity, or about $2,000 worse than the industry average. They put a 50-50 chance of these outcomes coming to fruition. Tesla confirmed that with Giga Shanghai, $1.6 billion in financing was necessary, which was set to have initial capacity of 150,000 cars. $1.6 billion divided by 150,000 cars leads us to a capital efficiency figure of $10,700 before any production increases. So where is Tesla at now? If we take the $1.6 billion for Giga Shanghai and divide it by 250,000 cars produced, that would be a capital efficiency of $6,400. And you can do the math. If you bump the cars produced number up even higher, to which the expectations are set at Giga Shanghai for the coming years, then the capital efficiency metric will continue to go down. But even still, that $6,400 capital efficiency number is already better than expectations for the industry and more than 50% cheaper than the ICE industry's efficiency, which once again, on average, sits at $14,000. And if you recall, Tesla had this to say: "We've also dramatically improved the pace of execution and capital efficiency of new production lines. Giga Shanghai was built in 10 months and is ready for production, while it was around 65% less expensive, capex per unit of capacity, to build than our Model 3 production system in the US." Now, look, before I continue, I know a lot of you are thinking to yourselves that this metric is limited, and yes, it is. The higher the level of vertical integration, the higher the outlay costs will be for the factory. In Tesla's case at Giga Berlin, they're spending to build the factory and the batteries, whereas when you look at the legacy industry, a much higher percentage, at least relative to Tesla, of parts are outsourced. So one could argue that these outsourced costs are not included directly in the capital cost, depending on who is putting the figures together. You also have to consider things like depreciation for capex expenses like buildings, robots, etc., because changes in capital efficiency do have an impact on gross margin, as changes in the capital efficiency of a company affect the amount of manufacturing plant depreciation that is amortized across each car sold. But capital efficiency changes are more critical in the sense that they impact the likely production scaling rates given the available financing. But of course, for the sake and scope of this episode, just know that this is a simplified metric, and yes, it is still very helpful in giving us a general context for capital efficiency, a very important metric in the long run. And with $20 billion in cash, Tesla can operate in a self-sufficient manner in the near term. The longevity of this self-sufficiency will largely depend on the free cash flow generated each year through 2024. If we take a look at Tesla's historical free cash flow generated, we can see that to date, they're not generating enough annual free cash flow to self-sufficiently spend $5 billion in capex each year, hence the desire to take advantage of high stock prices and raise capital to fund their expansion for the next few years, a very wise decision. In 2019, the most recent full year with data, Tesla generated $968 million in free cash flow. Another trend to note is the negative free cash flow seen in Q1 annually. Of course, prior to 2018, almost every quarter was negative, but in the last 3 years, this trend has held up. Elon did admit back in 2017, Tesla's capex efficiency was trash. We also know that the gigafactories are the product even more than the car. We see Tesla making huge changes from one gigafactory to the next with things like gigacastings, 4680 cell lines, new paint shops, and the list goes on. But no matter how you chop it up, Tesla is leading the way in terms of capital efficiency, and they will only continue to grow their lead with each new factory. As the raw investment numbers will increase for each gigafactory, so will the output and the level of vertical integration, perhaps the most overlooked aspect of capital efficiency if the outsourcing costs are left out of the equation for the competition. But that's gonna wrap it up for today's episode. I thank you guys for watching. I hope that you learned something new. Please like the video if you did, and consider subscribing for more Tesla content. But with that, I look forward to seeing you in the next video. I hope that you have a great day.